Welcome to this month's Economic Update. I'm Sinead, Rafferty, Portfolio Specialist at NAB Asset Management, and I'm joined by our Senior Economist, Bob Cunneen. Welcome, Bob.
Thanks, Sinead.
Bob, we saw another strong performance out of global markets in February. Was the primary driver for that the rhetoric that's come out of the US-China trade talks?
Yes, it was. So global share markets were up about 3% for February, which is very encouraging. And there were a couple of reasons behind it, but mainly it was talk about the trade dispute being resolved. So we saw signs from both President Trump that he was close to an agreement with China. We also saw a delay in raising tariffs, so the March 1st deadline has been delayed further. So that indicates we're closer to a resolution. So that was a key positive. The other positives for the global share market, the Federal Reserve, the American Central Bank, indicated that interest rates were on hold. They would be patient about raising interest rates any further, given what they saw in terms of muted inflation pressures in America in particular. And the other positive was that the corporate earnings reports for the December quarter in America were very positive, up 13% for the year.
Another market that performed particularly well in February was Australia, so up over 5%. What was the reason for that?
A couple of factors behind that. Firstly, we saw very strong commodity prices. So iron ore was up 15%, copper was up 6%. So the materials sector or the resources sector was up about 8% for February itself. The other factor was we saw, from the Reserve Bank's point of view, a view that interest rates are now on hold. They saw the risks to the economy as very evenly balanced. So that's very encouraging for the share market from that point of view. But also our share market benefited from the global rally in particular.
So you've mentioned that the tightening bias that the Reserve Bank previously had is now more of a neutral. Yeah. What's the market pricing in? Well,
the market is actually pricing in that the Reserve Bank will cut interest rates towards the end of this year, which is a bit of a surprise because the Reserve Bank's rhetoric is that these risks on the housing market to the downside against a very strong labour market at the moment is very much even probability of a rate move. So the market's probably got a little bit of ahead of itself. It's probably too ambitious on the RBA rate cut call. But if the inflation profile looks quite mild in Australia and if the economy is quite soft in terms of GDP growth, then there's still a potential for that.
Okay, so a lot of the data is still pretty mixed, is that fair to say?
Yes, it is. It's a very difficult to get a read on the Australian economy at the moment because we have an environment where we have very mixed signals. The labour market has surprised on the upside, whereas the housing market is surprising on the downside.
Thanks for your time, Bob.
Thanks, Sinead.